Welcome to Investor Hub X. In this lesson, we're going to cover the foundations of candlestick reading, including a brief history of candlesticks, what candlesticks really represent, how to read them correctly, and how different types of candlesticks reflect price action. Candlesticks are one of the most widely used tools in trading, but they're also one of the most misunderstood. This video is not about memorizing patterns or predicting where price will go next. Instead, we'll focus on understanding what price is telling us right now. Before we go further, it's worth briefly touching on where candlestick charts come from. Candlestick charting originated in Japan in the 18th century, where rice traders used it to track price movement and market sentiment. One of the most well-known figures associated with this approach is Munehisa Homma, who focused on understanding market psychology rather than predicting prices. What's important here isn't the age of candlesticks, but the reason they still work today. Markets are driven by people, and human behavior doesn't change. Fear, greed, hesitation, and conviction still show up in price the same way, whether it's rice, stocks, or Bitcoin. So let's start with the foundation: how to read a candlestick. Each candlestick shows four things: open, high, low, and close. The rectangle in the middle is the candle body, which represents the distance between the open and the close. The thin lines extending above and below are the wicks, showing how far price moved beyond the open and close. Let's start with a green candle. A green candle means price closed higher than it opened. The open is at the bottom of the candle body. The close is at the top of the candle body. The upper wick shows the highest price reached. The lower wick shows the lowest price reached. Now let's look at a red candle. A red candle means price closed lower than it opened. The open is at the top of the candle body. The close is at the bottom of the candle body. Again, the upper wick shows the highest price reached, and the lower wick shows the lowest price reached. So why are candlesticks important? Candlestick patterns are important because they show us what price is actually doing, not what we hope will happen next. Unlike indicators that are calculated from past prices, candlesticks are formed in real time. That's why candlestick analysis is often described as a leading indicator. When we say candlesticks are a leading indicator, we don't mean they predict the future. We mean they reflect current market behavior as it is happening. Every candlestick captures the interaction between buyers and sellers during a specific period of time. It tells us who was in control, who lost control, and where price was accepted or rejected. This is why candlestick analysis is often referred to as price action. Now that we understand why candlesticks matter, let's break down how to read candlestick patterns properly. Now that we understand what candlesticks represent, let's look at some of the most useful candlestick patterns for reading price behavior. These are not signals. They don't predict the future. Instead, they help us understand who is in control and whether that control may be changing. We'll cover 6 candlestick patterns that appear frequently across all markets and time frames. Let's start with the long wick candle. A long wick tells us that price attempted to move, but was rejected. If price pushes higher and leaves a long upper wick, it tells us sellers stepped in aggressively. If price pushes lower and leaves a long lower wick, it tells us buyers stepped in to defend that area. The key point is not the direction of the candle, it's the rejection. Long wick candles are especially important at support, resistance, and key levels. Let's look at a real example. This is the Bitcoin chart on the weekly time frame. Price first breaks above a key resistance level and then pulls back to test that area from above. This is a classic role reversal, previous resistance turning into new support. price tests this level once, gets rejected, and then comes back for another test. On this second test, notice this candle. It has a long lower wick. This is what we call a hammer candle. So what does a long wick candle tell us in terms of price action? The long wick shows that sellers attempted to push price lower, but failed. Price was rejected from lower levels, causing the wick to form. These long wick candles often appear when buyers step in aggressively, absorbing selling pressure and defending an important level. Next, we have multiple wick candles. When you see several candles in a row with long wicks on both sides, it tells us the market is undecided. Buyers push price up, sellers push it down. Neither side is able to maintain control. This often appears during consolidation or near important decision points. Multiple wick candles warn us that momentum is fading and that a larger move may follow. This is chain GPT on the weekly time frame. Here is a previously established weekly key level. When price rallies back into this area, notice how we start to see multiple long wick candle rejections. These wicks show that price is being rejected from higher levels. But at this stage, rejection alone is not confirmation. Many traders will attempt to take a short trade immediately at this level. However, a more conservative and higher probability approach is to wait for a bearish red candle to close. That bearish close confirms that sellers are actually stepping in, rather than price simply reacting temporarily at resistance. Rejection shows hesitation. A bearish close shows commitment. The third pattern is the inside bar. An inside bar forms when a candle's high and low are completely contained within the previous candle. This tells us the market is pausing. Volatility is contracting. Participants are waiting. Inside bars often act as a compression phase before expansion. On their own, inside bars mean very little. But in context, especially at key levels, they can be very informative. This is chain GPT on the weekly time frame. Notice how price experiences multiple rejections in this area, turning it into a clear zone of interest. As price moves up into this zone, observe this candle closely. Its entire high and low are contained within the previous candle. This is what we call an inside bar. An inside bar tells us that the market is pausing. Momentum is slowing, and neither buyers nor sellers are in control yet. Shortly after, price reverses from this area, showing how this pause occurred at a key level. Now let's look at it again. Price first finds support at a key level, then rallies back up into resistance. Once again, we see an inside bar, with the candle's range fully engulfed by the previous one. When this type of pause forms at a key level, it often precedes a move away from that area, in this case, to the downside. Next is a color change. A color change occurs when the market shifts from a series of bullish candles to bearish candles, or vice versa. This does not mean the trend has reversed. It simply tells us that momentum is changing and control may be shifting. Color changes are most meaningful after extended moves or at important levels. Now let's look at growing candles. Growing candles show increasing candle body size in the same direction. This tells us momentum is building and participation is increasing. Buyers or sellers are becoming more aggressive. When candles grow in size, the market is not hesitating, it is committing. This is silver on the monthly time frame. Notice how recent candles are not just bullish, they are expanding in size. Each candle opens near the previous close, travels significantly higher, and closes near the top of its range. This tells us that buyers are in control from start to finish of the month. As price accelerates upward, the candles become taller, with little to no upper wick. That lack of upper wick shows that there is very little profit-taking or selling pressure at these levels. Instead of hesitation, we see acceptance at higher prices. This type of candle growth reflects strong momentum, where demand is overwhelming supply and price is being repriced aggressively. On a monthly chart, candles like this do not represent short-term emotion. They reflect large, long-term participants stepping in. When monthly candles expand like this, the market isn't just moving, it's repricing. Small candles show negotiation. Expanding candles show conviction. Finally, we have shrinking candles. Shrinking candles show decreasing candle body size. This tells us momentum is weakening. Even if price continues in the same direction, the strength behind the move is fading. Shrinking candles often appear before consolidation, pullbacks, or reversals. This is the S&P 500 index on the daily time frame. Price initially moves higher but gets rejected, establishing a clear resistance level. When price rallies back into this area, notice how the green bullish candles begin to shrink in size. Each push higher shows less progress than the previous one. This tells us that buying momentum is weakening as price approaches resistance. At the same time, we see multiple rejections at this level, showing that sellers continue to defend the area. Shortly after this loss of momentum, price reverses away from resistance. The reversal didn't happen suddenly. The market was already telling us it was losing strength. Shrinking candles signal hesitation, especially at resistance. To summarize, long wick candles show rejection, multiple wick candles show indecision, inside bars show compression, color changes show momentum shift, growing candles show strength, shrinking candles show weakening momentum. None of these are trade signals by themselves. They are tools to help you read what the market is doing, not what you hope it will do. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.